Discuss why the survival of small and medium-sized local and regional banks are so important for us and why the Federal Reserve and big banks want to buy them up, consolidate, and further centralize the U.S. financial system. Smaller banks are crucial because they offer individuals like us several benefits over big central banks, like lower fees that help us save money over time, personalized services that help us find the best solutions for our financial needs, flexible loan decision-making processes that help us get access to capital we otherwise wouldn't qualify for with bigger banks, quicker loan application processing, more competitive interest rates, less bureaucracy, better understanding of our local markets, and better support for our local economy. Also, smaller banks actually help the economy at large grow by giving small local businesses capital in a way that does not create inflation. Because these types of loans create jobs, foster innovation. As technology gets better, things become cheaper over time. And it generally gives us everything we want in society without all the negatives. Here's how it works. When smaller local banks provide credit to people and businesses only for productive purposes, like lending to small businesses for business investments, implementation of new technologies, expanding the business, hiring new employees, and overall increase of productivity, it stimulates healthy growth of the local communities. And when done across the country, it stimulates healthy growth of the entire U.S. economy and more of a capitalistic economy overall. When a country just has one central bank and maybe a few big banks, it makes it difficult for the country to thrive and flourish because a vast majority of people and businesses have significantly less access to capital, which has an extremely negative effect on the economy and GDP. And lack of local knowledge about a community, coupled with higher rates, generalized versus personalized services, rigid loan decision-making standards, lengthy loan application processes, more bureaucracy, and virtually no incentive to support individuals and their local communities would further destroy the already deteriorating United States society, all for the benefit of a few greedy, powerful central bankers, bureaucrats, and big businesses that want complete control over every citizen and every dollar we earn by trading our precious time and energy working, trying to actually create value in the world. Central banks tend to distribute money unequally throughout the economy by giving it first to their corporate cronies and politicians, which is a key driver of injustices in our society because it gives them an advantage to invest in assets before they rise in price through arbitrage opportunities. This creates asset bubbles and does not drive innovation or help the economy grow. The unequal distribution of money in our current fiat systems benefits those closest to the government and harms those farthest from the government in a phenomenon known as the Kantian effect. And if you would like to learn more about how central banks and governments keep us poor on purpose, check out this video guide by clicking on the link above. Another major reason why the United States society is failing is due to a legal concept called corporate personhood, where corporations are granted more rights than humans. And with these advantages, they are able to buy politicians, to buy favorable regulatory environments in order to buy our attention via controlling the media, to ultimately keep us poor via materialism and consumerism. To learn more about corporate personhood and its effect on our economy, check out this video by clicking on the link above. Nice. So does the Federal Reserve and government at large have a secret plan they are executing in order to successfully roll out a central bank digital currency to effectively enslave us all? It's possible. And if they choose to continue increasing interest rates, it will result in more bank failures, bigger banks buying out smaller ones, mass consolidation and centralization of the U.S. banking system, obstructing access to capital for the vast majority of people and businesses around the country, all to execute one of the most heinous power grabs in U.S. history. Either way, more bank failures are likely to come. And something extremely important to keep in mind is that hackers and scammers love to exploit events like the collapse of Silvergate, Silicon Valley Bank, and more by sending out emails, texts, and all kinds of messages pretending that your accounts or similar have been compromised. They try to get you to send them information about yourself, your usernames, passwords, two-factor authentication, wallet seed phrases, private keys, etc. Or sometimes they say you owe fees or need to send them money or crypto to retrieve your funds or protect your funds or similar. They also set up fake websites to look the same as your bank, crypto exchange, or similar to try and steal your login credentials. And when we panic, we tend to freak out and try to act quickly, and that substantially increases our chance of being scammed. So make sure when we are looking to make some moves to protect our funds and digital assets to always stay calm, go slowly and carefully, and always double and triple check website URLs. And to protect us and our wallets when transacting online, there's a free browser extension currently in beta called Wallet Guard that acts as a security companion to our crypto wallet of choice, so we can browse the internet and interact with Web3 more securely. I've been using it over the past month and it's been working great so far, popping up warnings, helping check everything out before transacting, so it's definitely worth checking out and giving it a go in this crazy macro environment. Wallet Guard uses machine learning algorithms to detect phishing before a scammer can get access to your crypto assets. In their most recent update, the app now offers multi-layer protection services for our wallets. When interacting with smart contracts, like for minting NFTs, when accessing the site, Wallet Guard's phishing protection layer executes and warns you if the website might be harmful, if it was created recently, if it has low trust, and if you proceed to do so with caution. And when we do, before attempting to verify a transaction with our wallet, a second layer of protection is executed with a clear, human-readable warning about what exactly will happen if you decide to proceed with the transaction, like if it's going to drain your wallet instead of actually mint an NFT. It can also detect and will notify you if the site is making multiple attempts to interact with your wallet, trying to hack and steal your funds. So Wallet Guard is basically an all-in-one security dashboard for Web3. So make sure to scroll down and use the link below to access the correct and official site to download Wallet Guard's free extension to protect your wallet and crypto assets today. Awesome. So if you would like to learn more about how Bitcoin works and why its revolutionary technology can help us maintain power over some of our wealth, check out this video. If you would like to finally have that eureka moment about how cryptocurrency wallets, seed phrases, and private keys work, so you feel more comfortable as an investor, check out this video. And to download Wallet Guard's free browser extension app to protect your wallets, check out this link on the screen. Like and subscribe for more. Be safe out there.
If you had gotten in early on...
All right, y'all, so there you have it. Me, freestyling, of course. No script, as always. Not even a haircut these days. But anyway, what this young lady just said, that's my lady. That's Crypto Casey. She's really good with crypto, but not just with crypto. She just have a all-around amazing, thesis on the whole picture of our macro economics and macro financial status, not just in America but worldwide. She's very strong. I know a lot of things she know, but I think she may have me beat, and it's kind of amazing because she's younger than I am, and I know a lot when it comes to this type of stuff and the way our government moves and all. Even as a kid, I could see a lot of things, as a teenager and all. But she's obviously on point. And you can obviously tell I majored in business marketing, so I can tell that she either went to school for maybe business economics or something like that, or microeconomics or something, or financing, or I can say that she's probably has gotten her knowledge from something other than books, because they don't teach us this in books. I was in business marketing major, economics is one of my prerequisites, so. It's kind of amazing to see how, she speaks, and to see how, she thinks, and she's not how she thinks, how she lay down facts. It's amazing. You need to go check her page out. But the reason why I use her to intro this video is because that's pretty much what I wanted to talk about. I've been talking about CBDCs. I've been putting up videos and all talking about CBDCs. I think I put up a video, one moment, I apologize. I put up a video, I think crypto versus CBDCs or something of the sort. Or CBDCs, CBDCs versus Bitcoin. I put up a video about that, something like that, I believe. And also talk, more than, 2 years ago when I, originally got into crypto and all, I spoke about this, asset, especially the whole industry being, how it started and all, with the, black market and all, black web and stuff. And not just that, but, how the whole thesis of blockchain, how it's nothing but a ledger. It's nothing but storage of information, to be technically honest, with you. But it's still an opportunity to make some money. And it's more than an opportunity to make some money, because in the future, like you said, it was just like I said previously, it was just an introduction to get us to the concept of the idea of rally, or rally up for the idea of having a digital decentralized currency, when in fact the whole decentralized setup or network is all controlled by the people who already control our central banking systems. which is what I said more than 2 years ago, and when I first got in the industry. But there's still a lot of money to be made. Trust. It's one of those sneaking through the back door things, and you gotta have the facts, gotta have the information, because if not, then you'll be trying to book a long-term asset, and the asset will do nothing but lose its value because it has no utilities or anything. Versus, maybe putting money on an asset that really has no utilities, but it's going to really rally really well, and you can make a lot of money off a rally, even though that asset doesn't have any utilities. And the bigger picture of it all is, I spoke about this some time back about how CBDCs is going to be the choice of the governments across the world or whatever, but they're going to introduce us, with blockchain knowledge and all, and get us all rally, thinking that we're going to have a decentralized form of barter or exchange, and then come to find out we end up actually getting a more centralized, a more secured, a more controlled form of exchange. And I'm talking about, instead of us having cash in our hand and you being able to pay your barber, and that barber did not give you a receipt, so that barber does not have to report that and pay taxes on that. This new ledger, there's no way around that. Everything is scrutinized. Everything is recorded forever. It can be used against you at any given time forever, even 10 years down the line. And it goes into, judging you by your social, with your social status. And, it's amazing how it ties into so many different things, But more or less it ties into more, control over, how you spend your money. And money is the root of everything, So, it's one thing to be able to control where you are and, what type of things you like. It's another thing to be able to control where you're actually spending all your money. If you ever want to find corruption, you just follow the money. Same thing with finding a corrupt individual. You just follow the money. There's no such thing as anything done illegal. There's no such thing as illegal when, you're dealing with blockchain technology, when you're dealing with no cash, when you're dealing with, it's literally illegal for you to have cash at hand. When you're dealing with a situation like that, there's no such thing as hiding anything from the government. And the only thing that makes something illegal is if the government cannot see you. In other words, a good example would be, you can sell your cuckoo or your cootie cat, but it has to be in a brothel in Las Vegas legally. Other than that, any other state or any other place, or even outside of those doors in Las Vegas, you would go to jail. Why? Because the government can't tax you. They can't see you. If you're outside those doors, then there's no receipt exchange. You selling your body, which is, I believe, what you should be able to do without having to pay somebody else 20% to go do whatever the hell they want, like fight wars and shit that we have nothing to do with. But that's another story. But, yeah. So that's a good example, you being able to sell something like your own body, but you can only do it legally if you're paying taxes on doing it. And the only way you can do that is if you're inside of a brothel, only in one state that says it's legal. But anywhere else, even literally inside that same city and state and ordinance, if you step outside of that brothel, your ass is going to jail if you try to sell your own body. So in other words, everything's illegal if the government cannot see you. And with blockchain technology, there will be no such thing as the government can't see anything, unless you're maybe trading a pig for a cow or something. But other than that, when you accept the system, then you're accepting the fact that the government's going to be able to see everything, just like you accept the terms and conditions of Facebook when you sign into Facebook. And if you don't, you just can't participate in Facebook. So that's pretty much where we're going at. This is pretty much what she was talking about, and she broke it down a lot better than I can, obviously. But, like I said, there's still a lot of money to be made in crypto. Aside from that, some things that will be true, I believe Bitcoin will be a currency of exchange, even sitting aside a CBDC in America. Let's say, I don't know, Stellar or something like that, which I doubt it'll be Stellar, but let's just say Ripple or something. You would still be able to, use your Bitcoin. A lot of merchants would still accept Bitcoin. It'll be accepted. There'll be other coins, I think, that'll be still accepted, but the major coin or the main coin will probably be, of course, would be your CBDC. And all this, I think, it plays out to just so that we get all rallied up for something that we thought was decentralized and then being forced on something that is actually centralized. But at the same time, at least we've already been introduced to it, and when they go to lay out what's gonna happen to you with no say so, then it doesn't frighten you as much. Just like if they keep talking to you about aliens and alien surface, then it won't frighten you as much because you already have a gist of what an alien is and what to expect. And that's kind of like what happened with the whole crypto market, which is the reason why some people say crypto on the whole is a scam. Its origins alone would make you think it's a scam. But like I said, the bulk of my money is in stocks, of course. I'm actually moving a lot of my money over to, starting to move some of my money over to crypto. We're starting to invest a little bit more into crypto. Bitcoin right now alone is up 60+%. Companies like Solana, projects like Solana is up, I think 25-30+% right now as I speak. And then your altcoins follow or whatever. So it is a lot of money to be made in the industry, especially while Bitcoin's down to, let's say, around 28,000 right now. If it just goes back to 60, 70 where it was, there's a lot of money to be made. It's gonna go way higher than 60. Eventually it'll probably go to more than $250,000 per Bitcoin, to be totally honest with you, I believe. So, there's a lot of money to be made. But the bigger picture is that, CBDC, it's probably going to roll out around May. If not, maybe they'll push it off the next year, which I seriously doubt. So when you're investing, if you're investing in crypto, I think you probably would want to look up ISO, check out some of the standards that's already accepted, as far as, projects-wise. So you can get a good, glimpse of what may be the future when they do roll out their CBDCs and how they plan on exchanging and trading and all, and setting up their system, for future barter or whatever. And that way you get a good idea what to invest in long term, and then at the same time you get also a good idea of, how to separate your long term, when it comes to crypto, of course, how to separate your long term versus your short term or high growth. Because crypto, you probably want to do a little bit of research or whatever to know the difference between a project that's probably going to be around for 30, 40, 50, 60, 80 years or more, or a project that probably won't be around no more than 10 years, but would just may rally, a few times really well within the next 10 years. That's basically pretty much what I wanted to put out today. I'm not going to go into any of my portfolios or anything like that. I'll do that in my next video. I just wanted to, heighten the idea of, CBDCs, and understanding that, CBDCs is not with crypto to me. It's not my interpretation. CBDCs obviously is against crypto and against decentralization and all. And, how important it is to understand the difference between the two. And like I said, understand what the ISO, standards are, which companies and which projects have already met their standards, and knowing the difference between a long-term project versus a project that is just basically literally like nothing. I can open up a ledger and put an NFT on it, or non-fungible token or something on it, if I wanted to. So just to let you know how accessible it is or how easy it is as we step into Web3. You got to be really, careful, wary about how or where you're putting your money at in a crypto game. You got to do some research. But stocks, penny stocks, things like that, you can really go hard and end up getting soft up really fast in the penny stock game. But as far as your mega cap, your large cap, and more stronger companies, if you're new or a beginning investor, I would advise you to go into some of your more concrete companies like your Microsoft, your Google, Amazon, companies like that who's got a proven track record. That way you're pretty much just jumping on the bandwagon, and it's just a matter of time when you jumped on the bandwagon and catching that asset for as low as possible, maybe cost-based averaging while going ahead to your, goal point. And maybe, throw in maybe 20-30% ETFs. That way you can't go wrong. And be real particular about the ETFs you choose, because you'll probably be with them for more than 10 years. That's a long-term growth, a long-term investment. And that way, those ETFs will help, balance out your portfolio. You're dealing with mega cap companies like a Google or something like that, or Apple, and you're also following that with ETFs. You almost can't go wrong. The objective is, compounding, growth, growth over 10 years, maybe growth over 20 years. And once you get into the compounding growth, then you see the great law of decimal points and commas and digits and stuff like that. And how exponential growth is so much more different than actually trying to build income. It's kind of amazing. It's more, always comes back to time, which is what I always say. Patience, how virtue patience is. Kind of wish I would have started investing a lot earlier. I've invested a few times, maybe 401k, Cobra, crap like that, through corporations like AT&T, MCI, Sprint, companies like that, maybe Comcast. Some of the other corporations, maybe in the vacation industry, Sunterra, TAN, companies like that. Wyndham Resorts, I've invested with companies like that, mainly into, tourist type of stocks and stuff like that, maybe either through 401k, but never really went out and got my own portfolio, my own specific portfolio, and then started investing. I didn't do that until the beginning of the year 2021, after the loss of my mom. That's what inspired me, make sure that I'm, never without, and knowing that would make her very happy, So, yeah, that's it. I don't want to take too long, but you can check out some of my other videos. You can check out the link in the description. I have a few links, a few sponsors in the description. If you wanted to also let you know, if you wanted to open up a Coinbase account right now, is probably the most perfect time to do it. Like I said, Bitcoin's up 60%. It's only 28,000 from the previous 20,000, which is pretty good because its high was around 60 to 70,000, which means you're pretty good timing. And then the altcoins, of course, they always follow. And if you're interested in maybe setting up an exchange, or maybe want to start out with $5-10, these exchanges, you don't have to buy a stock at its full market value. You can buy a stock you can literally take a $5 and put it into maybe a $200 stock if you want it. It doesn't have to be, if that stock is $200, you pay $200. The stock can be $200, but you only put $5 down on it. And you still get the same percent of growth as I would if I put 1,000 on it. Still the same percent of growth. So the 5 exchanges that I'm on, and I'm on these exchanges and have been on these exchanges, so I trust them because my money's on them, and I'm not paper trading. This is my actual money on these exchanges. The first, of course, is Coinbase. The second, of course, is Crypto.com, of course, the crypto exchange. And then the third one is Fidelity. The fourth one is Webull. And the fifth one is Stash. Those are the 5 exchanges that I'm on. And I have a link to all of those exchanges inside of my description here. And if you want, all those exchanges give you either stocks or cash or something for you open up the account with my referral link. So not only will you get money and stocks, depending on what exchange you start with, I would get that as well. So it helps the page, it helps the channel, and it helps you start off because, like I said, you can just go in, open up an account on any one of these exchanges that I mentioned, and put in maybe $100, deposit $100, and literally they give you, let's say, $25 or whatever it is they give you, whichever exchange you choose, and then you could take that 20, buy yourself some stock along with your 100, and then you got $120 worth of stock. And you got it at the most perfect time. I've been, airing my portfolio out for everybody to see it. I don't care. I've been told not to do that. As I grow, I won't do that as much. I'll probably paper trade a little bit as I grow, but I'm not worried about where I'm at now, level-wise. If I did, I wouldn't look the way I do. The whole objective is to show my growth. So I purposely want to look rough at the beginning because that is what I claim. That's who I am. But any one of these exchanges will give you money, will give me money as well, or stocks as well. So when you go in, you put your money in on the exchange, you maybe deposit $100, they give you their credit, and $20, $25 worth of stocks, whatever they give you, depending on the promotion and exchange. I get the same thing. And yeah, you can go in, like I said, the stocks right now, some of the prices of these stocks right now are unbelievable. You're catching prices that were around during the 2008 depression. Or prices that were around 8-10 years ago or more. And like I said, it's more about time than it is about actual money. Catching that asset at, let's say, 60% of where it was, let's say, a year and a half ago or a year ago, when it's done nothing but for the last 10 years go straight up. And then now, for some odd reason, you jump in the market at the perfect time where the stock has actually gone down 60%. And that's where we are right now. So anyone who jumps in, it's not a matter of you just being a good investor. It's just more of a matter of time and, great timing. So, and then you can, get to your goal point. And then, I recommend, I know it sounds really weird because you've never heard this before. I've listened to, Jesus Christ, I've done so much. I'm talking about, I got like 10 books full of research, and I've never heard anybody say what I'm about to say. And that is never take profits. I know it sounds crazy, but exponential growth is exponential growth, and exponential growth is not being taught if you're taking profits. And that's all I hear everywhere, take profits. Yeah, you want to take some profits in the crypto game for sure. You want to take some profits in your penny stocks for sure. Because it could be like literally 30 years before that stock goes to $2 or something from, let's say, 50 cents. But when you're talking about a mega cap stock, something like that, or ETF, unless that's being met with a disruptive industry that's going to take it out, or a company that's going to take it out, then I would just keep investing until I start to see the incline change. And then, find another innovative idea to invest in and try to catch it at its earliest point. And then ride that out for maybe 20 years, if time permitted me, is what I would do if I had the opportunity. So, taking profits, yeah, if maybe, let's say, we went 5 year on a 5 year bull run, and maybe we met another, bubble, and everything popped again, and everything went back down another 60%. Yeah, in a situation like that, yeah, you can take some profits. But even then, I would strike my profits at no more than 25%. Literally, no more than 25% of profit, not of total, of gross, but of profit. And, no more than that when I strike it. And the objective would be to leave as much equity in that particular stock, even while the stock is going down. And then maybe once it meets its bottom point, maybe only taking no more than 25% profits off literally profits. Maybe when it meets its bottom point, then trying to cost base, right as it's going down to the absolute lowest bottom point, and then, ride it up again. But if I had it my way, I would love to be on all my positions right on point where I wanted to, my goal point, right on all my positions, and then ride the wave and never even invest again in those positions. And I know it sounds weird, but I don't want to screw up my cost base point. I don't want to I bought a stock at $90. My average is $90, but then now I'm striking that same stock at $200. I'm screwing up my cost base average if my objective is to exponentially grow over, let's say, 20 years or 10 years. So that's the last thing I want to do. I want to be done striking that particular stock once once it's met its bottom. I want to be able to look back 10 years and say, my cost base average is $90. And when I look back, 20 years, I can see that was the lowest cost base average over the whole 20 years. And I got the absolute lowest cost base average average that I could have possibly gotten. And I believe that's my job. And my other job is to also, make sure I'm able to stop that investment when that investment has met its point of doom. Everything comes to a doom, and it's usually done by another company that's able to do it cheaper and better. Something maybe more innovative, switching from the sword to the laser. And that's my responsibility to catch that as well. If I have a Google and somebody just came out of nowhere and can do Google, everything Google does for, a tenth of the price, like what Tesla did with SpaceX and all. If, a company did that, then it's my responsibility to catch that and start, striking, not all at one time abruptly, but they strike, and feed that other company that's growing more to get the maximum growth out the other company as I, downsize my previous growth company, which was, let's say, for example, Google. That's my objective. Those are my two jobs, I believe. And, I never seen a portfolio yet that had a percentage sitting alongside of a stock that says 600%, 300%. 200%. I've never seen it. I can't say I've never seen 200%. I've seen Warren Buffett. I think he had a 200% plus in one of his assets, but I haven't never seen a portfolio that has a stock that has 200% plus gains. 300% plus gains. I've never seen it besides the one time I seen 200+%. So, and that's my objective. My objective is when I retire from doing this, or when I say, okay, I want to liquidate, or I want to, grab some liquidity from all this. Let's say take 50% of all this. Then I want the other 50% to be, I really don't care money. Maybe I'll leave it to somebody else to manage or something, But once I've met my maximum, then, I'll eat a little bit. But it'll only be at one point, and it'll be at the point of my maximum, or what I expect, which is, let's say 10% over, let's say 10 years. Then, I'll touch it. But after that, what's left, is set for growth, and it'll be whoever manages, if not my management responsibility, to find the new and innovative companies that's going to give me the same return that I got on that company. I hear 20-30% per year, and I know I sound crazy by saying I'm expected to do nothing less than 50% per year. And I'm choosing, assets that normally don't do 50+% per year. But I'm sounding a little crazy by, I guess, overestimating in most people's eyes, simply because I see some things that I don't think most people see. And it is what it is. So, I have reasons for overestimating. The main reason is catching it, like I said, at the lowest point possible, and then not keep trying to build on that point while the stock is continuously growing. I want to be done with that stock if it's at 50% growth or 70% growth. And I have a few stocks in my portfolio where I wish I could have caught it a little bit better, but I just couldn't catch it. I was, I guess, distracted by other stocks. I have more than 120 stocks I have more than 130 stocks in my stash portfolio alone that I have to manage. 130 assets. That includes my ETFs, which is about maybe 20 ETFs. So about 110 to 120 assets, along with about 140 total, including ETFs, not including any crypto on stash. That's just stash alone. So, I missed a lot of stocks on my stash account where I wish I would have caught them a little earlier, before they grow up, but they just start exploding, like 12% in one day and 10% in one day. And I'm like, oh, Jesus Christ. Right after I just spent all the money hitting other accounts, other assets. So, it's rare, but I have a few stocks on my account where I may be at 70% growth already. Even with this being downtime and bad time and everybody's complaining, I have a stock in my account right now where I'm at 70% growth. I have other stock where I'm at 50% growth, a couple 40% growth, a lot of 30s, a lot of 20s, where we're supposed to be doing bad. So, and the objective is not to strike them ever again. If something's at 70% in my account, I don't want to be striking it anymore. I I want to be done with it. And I know it sounds weird. You only have $70 on that, and you don't want to strike it in. No, I don't want to strike it in. That's not the way how law and numbers work. That's the way they'll teach us everywhere we go. But that's not the way it works. You don't need anything more than $100 over 10 years to grow a good exponential amount. And especially if the stock is already done that. You literally jump on a bandwagon, buy one stock, and you probably have a better chance of buying that one stock and doing some outrageous performance with that one stock than you would trying to build a diversified portfolio, which is what everybody teaches you. And even yet and still, I have more than 120 assets, not including ETFs, 120 assets on stash alone, not even counting ETFs, And the only reason why I'm doing that is because I'm not just thinking of exponential growth over 10 years. I'm thinking about in 10 years grasping, something of that to eat, or for myself. And then all these assets spread out, so many different assets grow so much exponentially over, let's say, 30 years, 40, 50, 60, 70 years. Now we're talking leaving behind generational wealth. Even if I only put $30 in a stock or $50 in that particular stock, not touching that stock and getting that stock 30 years ahead of time, and that stock turned out to be growth every year, even if it's only 10%, 15% growth every year over, let's say, 20, 30 years on average. You don't need me to tell you, multiply by, let's say, 100 different assets, what that'll be worth for family members 10, 20, 30, 40, 50, 60, 70, 80 years down the line if those assets are managed properly. And that's just how the wealthy gets wealthy. They don't get wealthy off of income. They get wealthy off of assets. Assets that appreciate, not assets that depreciate. And what I'm trying to do is a prime example of that and show anybody how you can look as rough as I am, be from Baltimore, 21229 zip code, and be about as regular as you possibly can, even maybe smoke a blunt here and there. And literally, instead of killing yourself working every day, maybe you're self-employed and you generate income. Not every day. Maybe you do it once or twice a week if that's what you want. Maybe you generate income while you're going on vacations or recording, and people watching you do vacations, and they keep watching your videos, and you get a lot of hits. And next thing you know, YouTube is paying you for your vacations, and you take your vacations and invest it into assets instead of taking your vacation your vacation profit that you've gotten from, let's say, YouTube, instead of spending that. Keep investing that into your, let's say, YouTube business and buying unnecessary things like maybe clothes to splurge or whatever, or too much clothes to splurge. Maybe instead you can take some of that money that you make from your, let's say, Facebook, OnlyFans, YouTube, whatever you're doing, maybe you sell trade beer cans in for recycling, or electrical cords that you stole off somebody's house. I don't know what you're doing. But take some of that money, and instead of trying to grow income off of it or money off of it, grow an asset that appreciates off of it. And that's it. It's what we've been told all our life. I mean, even as hustlers, it's very rare to find a hustler that's going to go out here and sell some damn drugs and then take the damn drug profit, and instead of buying more drugs with it, they're more, interested in buying some stocks. But very rarely it happens. And that's just not what's taught to us. It's what's told to us. Even as a hustler, you're told, hey, man, won't you put some of your money back, make it grow. But you very rarely hear some person tell you, well, won't you put your money in the stock market or crypto? Like, nigga, who the hell's put their money in the stock market and crypto? And I'm standing here in the cold all day selling and flipping these damn drugs. You crazy? So, but just imagine if you did. Just imagine if you took your re-up money, for example, and instead of spending 100% of re-up money, you just took out 20% every time you went to re-up. He's like, yeah, I'm not going to re-up like I always do. I'm going to take 20% out, and I'm going to throw it in the stock market game. It's like throwback money. Same money I would have threw on that chick, not meaning to throw on her, or on that grass, or in a casino, not meaning to, throw that in the casino, or maybe a couple outfits. I'm going to throw that, make sure that every time I come up, before I go re-up, I'm going to take 20% of that, and I'm going to put it back. That's called throwback. I'm going to throw it away, hoping that in the future, not only will I change my life, but I'll change my kid's life and so on and so forth. And once you get to that way of thinking, not just thinking about yourself, then you'll understand that enough money is just not enough. If you're trying to take care of somebody generational wise, then you just don't need money. You need something that's going to grow even when you're not here. And you'll eventually come to the conclusion of assets that appreciate. And you'll eventually from there be pushed to, okay, well, stocks, intangible goods, digital assets, things that I don't have to, manage or govern, too much, which is what the whole basis of money is made off of anyway, I mean, especially when you talk about fractional reserves and crap like that, it just lets you know how fictitious all this crap is. So, you might as well go ahead and figure it out how to do it the digital way, or I guess the fictitious way. And what is more fictitious or more digital than intangible assets like stocks and cryptocurrencies and stuff? So that's why I'm here. We'll see how it turns out. Remember, this is at least a 10-year journey. So if you know anybody who's interested in seeing a regular old person make some money, without having to go spend his time and his energy to make a lot of money, then, hey, I'm here. And I'm going to keep it the same way I'm keeping it. And I don't care if I have 1 follower or 1 million followers. I just want my followers to be organic. And if I grow, I want them to grow too. If they see my 60% in my portfolio, which is completely transparent, then they know they can do it too. That's what it's all about. That's it. Check me out on my next video. Thank you.